From the morning reading, stocks broad rebound from Brexit two-day sell-off led by energy, financials, and discretionary. Volatility sinks. All 9 sectors moved higher on Tuesday. XLE, XLF, and XLY were the strongest sectors, while XLU was the weakest sector. Oil futures rose $1.46 to close at 48.07. Breadth strengthened as advancers led 2608 to 584 on the New York Stock Exchange and 2070 to 551 on the Nasdaq. On the S&P 500 snapshot, a post-Brexit bounce. The global post-Brexit sell-off reversed itself with yesterday's action. Most Asia-Pacific indices were modestly higher, and major European indices saw major bounces. The FTSE rose 2.64%, the CAC rose 2.61%, and the DAX rose 1.93%. The rally spilled over to U.S. equities. The benchmark S&P 500 opened at its 0.31% intraday low and spent much of the day in a narrow range just north of plus 1%. A second wave of buying in the final 90 minutes lifted the index to its close spot at an intraday 1.78% high. Can the rally continue? Treasuries, however, showed no reversal. The 10-year note closed at 1.46%, unchanged from the previous session. That's a mere 3 basis points above its all-time closing low of 1.43%. Tuesday's up volume reversed Friday's horrid number. To end the week last week, less than 10% of volume flowed into advancing stocks versus more than 90% flowing in on Tuesday. When we see such a quick reversal of severe selling pressure, is typically led to higher prices in the medium term. Unfortunately, there are also negatives. A widely followed money manager and commentator pointed out the fact that on Monday, there were a large number of securities on the New York Stock Exchange that traded at a 52-week high and also a large number at a 52-week low. Such a wildly split market has served as a warning sign for decades, and it's been a good reason. When stocks close the opening gap from a large down day, they tend to drop. When Spider has reversed the losses from a bad gap and drop day, it has tended to bring in sellers over the next 1 to 2 weeks. The biggest fund inflow over the past week has been gold. It took more than $1.6 billion, which is amongst the highest in the past 5 years. This hasn't been a perfect contrary indicator, but extreme flows in the fund have been more than a contrary guide than not, suggesting a headwind from the metal from here. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:30 a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 29th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report, and we've had something of a continuation from yesterday's bullish action. So all 4 of the U.S. broad-based indices at the time of this cut are up about 2/3%. Crude oil's up about 0.75%. The euro's up about 1/3%. Bonds, though, continue to also be moving up, and they're up just above scratch. Gold's up about 1/3%. In overseas action, you have China up about 2/3%, Hong Kong up about 1.3%, Japan up about 1.6%, Germany up about 1.4%, and the United Kingdom up nearly 2%. And macroeconomic reports for today of note for the United States, you have the core price index, personal spending group, pending home sales, crude oil inventories weekly report, the bank stress test results, And then looking forward to tomorrow, and it's really small. There was so many reports, I had to kind of crunch it. You have the weekly version of the unemployment claims, Chicago PMI, nat gas storage. And that looks to be about it for the United States. In terms of current volatility conditions, the volatility continues to come down, and you heard one of the morning authors make reference to this. Indeed, the short-term VIX now below a 20 to a 19.08. Though on the flip side, skew, this is one of the highest numbers I think I can ever recall on the skew. So this is very much in warning status and runs about a 14+% probability of a 2 standard deviation move in the next 30 days. IV percentiles fell yesterday with the S&P going to a 29, the Russell at 35, the NASDAQ at 24, and the Dow at 26. It looks almost like a Christmas tree when you look at the kinds of standard deviation move patterns we've had in recent days. We've had, the big colossal Friday session where we had, and I think this should be a -3 actually, but we had 3 of the 4 indices with 3 standard deviation moves, and then the NASDAQ at a 4, and then that was then followed by 1, 2, 2, and 1 negative standard deviation moves, and then yesterday's bounce bringing us up a standard deviation move on each of the 4 indices. So an extremely volatile and very whippy market. You look at, especially on the Russell, a +1, a -3, -2, +1 in the last 4 trading sessions. So a lot of movement. And one of the things, let's go ahead and go to the charts, so after you do all that movement, you just end up right back where you came from. And that's been kind of the theme of so much activity in recent days. Well, not so much. And if you look at the S&P, while you might have been, down 3, and then down 1, and then up 1, and then so far today we continue to be positive. Well, notice the bounce back hasn't come anywhere close to regaining where we started from. So in fact, we're probably looking at about a third of the way back, not yet halfway back. Halfway back would probably be closer to 2050, though it could certainly get there today. But still, keep in mind, just how much technical damage has been done. Yes, we've had a big bounce, but we haven't even begun to make up the ground to get us back to where we are coming from. So that's the short-term situation. The more intermediate-term situation, of course, we're just in this big, wide range up against this big area of resistance running between about the 2100 area and 2134, which continues to repel the bulls over and over and over again. At the same time, you have to give credit to the bulls that they are able to dominate the bears when necessary. And while we've had some kind of scary falls, we just continue to repel any kind of significant real bear market recessionary cycle breakdown to the market as well. So we just in this limbo in between those two extremes, and we continue to kind of rip from one side to the other without ultimately seemingly accomplishing very much. Back to the short term on the Dow, very much the same kind of pattern. Very high correlation between the Dow and the S&P and recent trading sessions. They're usually high, but even more so recently. NASDAQ also having a bounce, but a long way to go to make up the damage that has occurred. Also note that on the NASDAQ, you've been really kind of putting in not similar highs, but lower highs. We now have 3 lower highs, and we have a lower low. So this pattern continues to kind of point to an intermediate term breakdown on the NASDAQ. The Russell also has had important swing highs that have been lower highs and important swing lows that have been lower lows. So we'll see where this kind of move takes us. But overall, the intermediate term has been deteriorating of late. In terms of volatility, volatility, of course, has been coming down. We looked for the spike, and then we looked for the signal that the vol cross was on, and we got that with yesterday's close. So volatility has certainly been coming down very dramatically since that spike on Friday. You look at the regular VIX and down below an 18. So now as of yesterday's close, we are still above 18, but it looks like today's action is going to take us down below an 18. We'll see if it closes below 18. Gold has been a bit of a retracement, and you heard one of the morning authors make reference to the huge inflows into gold in the last trading week, and how that has not often been a good sign for the gold bugs and real follow through. So often just about the time when everybody jumps on the bandwagon with gold, it reverses and disappoints. And then crude oil, which has been highly correlated with the market of late, has been in something of a sideways pattern net of the last 2 weeks. Broke down out of this very long-term channel, and then basically it's just gone into a consolidation pattern sideways. Still kind of holding primary support areas, and certainly still above the cloud, and yet at the same time, you know, important swing highs that are now lower than the previous swing high. That's the first time that has happened in quite some time. I believe perhaps we had a similar high here, but then a continuation. So, you know, we've gone really months since the February low in crude without a major swing high being lower. So we'll continue to watch this. Now, while you had that lower high, you had a similar low. So just right now, sideways consolidation going on in crude. That could be a tell. Watch the crude oil chart as to where equities might be heading. And then let's take a look at bonds. Bonds also were something of a contrary signal. And we talked about this yesterday morning's session as well, that while equities were bouncing, bonds weren't exactly giving it up. And indeed, they, on yesterday's candle, you know, were actually had a new 52-week high and closed higher. So this is not the sign that people are pulling money out of safe haven and back into equities in a big way yet. Bonds seem to be holding on to its recent breakout gains. Let's go to the daily report, and we continue to have deterioration show up over here. Now, what has not changed is up here at the very top. We're still market phase 5, the in short term, the break of horizontal diagonal support. Waiting to see if we can reverse that, but that has not yet happened. In terms of our market timing signals, we have 3 we follow, all mechanical in nature. The first one from IBD, which is still in market and correction, the worst signal. In terms of GMI index, also still with a sell signal, and that one's been in place now for a couple sessions. And then from the decision point scoreboards, no change from yesterday, but we were left with the situation with the short term very negative, and the intermediate term starting to deteriorate, all against the backdrop of the long term being very mixed. Position sizing opinions, no change for today's session, still at 0%. And I guess we will call this 50% on the volatility-based system. In terms of intermediate term market posture, we did have changes here to join a couple of the indices that were already at strong bear. The last 2 flipped over, so now all 4 indices are showing strong bear intermediate term market postures. Hedge warning status remains at level 2, which is a red light. Not a good idea at all to initiate any new bullish short-term or intermediate-term trades. If you're a novice trader, look for a confirmed turn of the market, and you'll often see that signal in a number of ways, but one of the ways that you'll see it is that this IBD will go from market and correction to confirmed uptrend, and that'll give you a signal that things have stabilized, and for novice traders, a much cleaner kind of entry. Now, that being said, we have been really whippy in recent months, and we've had a whole series of these market and corrections and then confirmed uptrends to ultimately achieve nothing for either the bulls or the bears. So kind of keep this in context as the kind of market that we've been operating in, and that hasn't changed yet. In terms of special opinions to option income strategies, if VIX is not within the acceptable window to initiate new positions for novice traders, though if we get a close below 18 with today's session, which is setting up to do that at this point, that definition would change. Covered calls, also conditions not acceptable to initiate new trades for novices. More aggressive traders consider 2-to-1 ratios of in the money, out of the money, and 2-to-1 ratios of low beta, high beta. Even better, consider legging in through out of the money put selling in this kind of a market. Now, the volatility is still escalated, and that can serve as an advantage for more aggressive traders, especially if you're selling puts and put spreads. Just keep that position size in the scale that you're willing to own, because we are clearly not yet out of the woods in terms of this bounce. The big question, of course, is this just another dead cat bounce? Are we just setting up for a bear flag to leg lower once again? Or is this a capitulation bottom and, it's all in? One of the morning authors I was reading didn't necessarily share much detail on, certainly is trying to make that call and say that we've had a capitulation bottom and that we are setting up for, opportunities for buying opportunities. I tend to be a bit more conservative and wait till a more confirmed move. That means I don't get in as early and can be in later and don't have the same opportunities as the more aggressive entries. But it's also where my own personal investing and swing trading style finds a greater level of success for myself. So that's something you got to keep in mind. I tend to be a bit more conservative on my re-entries after these kind of waterfall events. I wait for when I think the coast is a bit cleaner, and make my entries start at that point. So there's a price to be paid on both sides. If you're aggressive, you'll be right sometimes and win handsomely, but you'll also, on the flip side, probably have a much less win rate and have some failures where your early entries just automatically, within a few sessions, get squashed. In terms of the particular signals, market and decline still fired. We with that big spike that we had on Friday, that's now fired a vol crush signal, so that's a bullish sign. We also have these VIX futures getting ready to go below 18. Haven't quite happened yet, but certainly that's setting up for a bullish sign. And then on the other side, well, on the same side, I should say, the bull side, the 10-day out expected move is still elevated, but it's been coming down. This was up over 70, then up over 60. Now it's up over 50, so definitely coming down. That gets down below 40, and that will go back to normal status. Of course, we mentioned the skew, very elevated, well up over 150, so that's something of a warning sign for sure. In terms of the New York Stock Exchange yesterday, while we had a big bounce, it was very mixed. In fact, one of the morning authors mentioned that in terms of 52-week highs and 52-week lows, they were about an equal number. So very, very mixed signal there, and generally not thought to be a confirming signal for the bulls in the intermediate term. Intermarket risk aversion indicators, this is usually one of our more sensitive indicators to tell us that things have truly, turned. Well, they've not turned yet on the key intermarket risk aversion indicators. They're all solidly in the risk off posture, so keep that in mind. In terms of sentiment, very neutral sentiment on stocks, short to medium term, and including the fear and greed index, also very, very neutral there at this time. Bonds and gold, somewhat elevated risk with respect to bonds, especially. Gold has been ebbing off. Really, that's probably more like normal at this point with a 6 out of 10. In terms of the sector-specific behavior with yesterday, of course, it was a big bounce, and that helped improve some of these sectors. You note telecom and utilities, though, are the two that are holding up across all three time frames most consistently with this up posture. And while some of these others, energy, for example, financials, had big bounces yesterday, their overall postures are still pretty negative. So kind of keep that in mind. Everybody was up yesterday, and obviously when you're moving strongly up, you have things like the staples, utilities, and telecom. They're the ones that move up the least, but they also fell the least. And you note that while energy was up 2.64% for the day, it's still for the 5 days down 2.4% and negative for the month, whereas these consumer staples, utilities, and telecom are all positive, for that 1 month, and for that matter, 3 month and year-to-date time frames, all the way out to the last 12 months, whereas energy is still down double digits. Financials down double digits for the last 12 months. So just kind of keep in mind, where is the money consistently going, and where is it holding its value in the current market? Well, it's these bottom three from yesterday's action that have been producing the best overall returns in these more intermediate term time frames. Okay, that should be enough for today. We're up over 20 minutes, so let's close this down. And then we'll go to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink here at the bottom for the full set of disclosures. And we'll see you back here for the next trading session with the Falcon Global Market Preview. In the meantime, manage that risk. That will ultimately do more to produce your profits than anything you can do. Manage that risk and then trade very smart in this kind of a market environment. Good trading.